As before now, we've got our eye on banking names. Ajit Kumar, lead BFSI Research Analyst at JM Financial Institutional Securities, is now with us on the show. Ajit, morning. This is Reema here. So we know that the system-wide loan growth has been averaging about 10%. But can you give us a breakup of individual segments, housing loan, the vehicle loan growth, LAP, the MSME? What's been the loan growth, and how does this position the growth numbers that we'll get from banks and NBFCs in Q2?
Yeah, sure. So good morning, everyone. Thanks for having me. So yes, you highlighted it right. The biggest reason, in financials is for worry in financial is low credit growth of around 10% in India, YOY. If you talk about the breakup of that, roughly 25 to 30% of that is going to be corporate loan growth. And private capex has not been picking up materially in last, let's say, 3 to 4 years. And corporates have delevered themselves, which is leading to low single-digit corporate loan growth in India. In corporate loan growth, loan growth is somewhere between, let's say, hardly, 4 to 5% on a YOY basis. In retail as well, which is another, let's say, 30% of the total pie, in last 2 to 3 years, personal loan, credit card loans were growing at 20 to 25%, which has now come down to, a single-digit, growth due to the over-leveraging issue. While the RBI and our government has taken multiple steps, such as, front-loaded rate cut of 100 basis point, personal tax rate cut, recent GST cuts, we have not seen, much improvement in credit growth till now. As per the latest print, credit growth in India was, hardly, 10.3%. Even on GST cut, while it is going to be positive for auto companies, but from financing perspective, it seems to be negative as financing happens on all inclusive pricing, and hence there is a value decline which is going to happen. So net, our belief is credit growth is going to inch up due to this multiple step. But having said that, max to max, it will go to, let's say, 11 to 12% by FY26, not more than, 12%, when we end the year, in March 26.
So you're saying even though we're getting bumper sales numbers and we might get, good buoyancy, for vehicle financiers, it will be negative. Is that priced into the stocks, or is there scope for downgrades?
No, our sense is for vehicle financiers, their valuation is, way too high as compared to their historical averages. And as I said, in all these segments, there is a pricing cut which is happening. As per our channel checks, in used vehicle, pricing has already come down to 67%. And in new vehicle as well, as I said, if the GST rate cut, which has happened, let's say, on the lower segment vehicle from 28 to 18%, in the higher segment vehicle from 53% to 40%. So approximately there is going to be a value decline of roughly 10%, right? 10 to 15%. So unless we say that, value growth, while there is going to be buoyancy in the volume growth, but unless we make a case that, volume growth is going to, increase in volume growth is going to compensate for this loss in the value growth, your total industry growth is going to remain muted. So as per our analysis, from financing perspective, since it happens on all-inclusive pricing, disbursement growth is going to remain muted, in FY26, which is going to have negative impact on the loan growth. And in some of the names, that is not priced in actually, especially for the auto financiers.
Which ones is it not priced in?
Not priced in.
Can you tell us the names?
Yeah, so like, for example, we have been negative on Cholamandalam. The valuation is, way too higher. Historically, let's say when they were growing between 2010 to 2020, Chola used to grow at 20% CAGR. At that time, the valuation used to be lower. Now, in FY26, our assessment is loan growth is going to come down to roughly 20% versus, let's say, 35 to 40% that they have done in last 2 years. And 60% of Chola's book is roughly, auto loans, where we do see, disbursement issues cropping up. So, so Chola is going to be one place where we are negative. For the other auto financiers as well, like, for example, Shriram and MFS, disbursements are going to be, to get the disbursement, it's going to be challenging. But having said that, there the valuation is, not that, steep as compared to Chola. So that is why in the vehicle financier, our, pecking order is, Shriram, followed by, let's say, MFS and then Chola.
Any other stocks in your coverage where valuations are high?
Yeah, so for mostly, we prefer banks over NBFCs and large caps over mid caps. And one of the key theme here is we actually have a preference towards names where valuation is benign, and at the same time, there is no asset quality risk. And in that backdrop, all the mid-cap names, whether it is on the banking side or whether it is on the, let's say, NBFC side, where valuation is just way too high, we are not comfortable with those valuations. So as I said, Chola is one name. Some of the affordable housing names where, valuation is more than, let's say, 2.8 times, 3 times, there we have, some bit of issues because in the adjacent segment to personal loan credit card, like, for example, in low ticket size business loan, LAP loan, micro SME loans, the asset quality issues are cropping up. So in mostly in NBFCs and mid-cap banks, which have higher exposure to this, stress segment, and where the valuation is completely high, those are the places we are actually negative.
Got that. So your preference is for large private sector banks?
Yeah. So it's going to be, first of all, it's going to be banks over NBFCs and, large caps over mid caps. So our preference is more for, let's say, ICICI Bank, HDFC, SBI, and large banks. In mid cap names, as we need to be highly selective, and that is why in mid banks we like City Union Bank. In NBFCs, our preference is more for the large names. Bajaj Finance we like, AB Capital we like, and in the mid caps again we have to be very, very highly selective. So like PNB Housing we like, because the valuation is hardly, let's say, 0.9 to 1 time with no asset quality risk. Then in affordable housing name we like Aadhar and Awas.
Very quickly, before we let you go, Ajit, any view on Bajaj Housing? A year or so ago, the stock went dancing away more than 40% post-listing in a matter of a few days. From there, it's come down to 110, 115 rupees, which is more palatable, given that it had gone to, I think, around 6 to 7 times to price to book. Not cheap, but given the parentage, given the scope of growth, what's your view on the stock?
Yes. So no, obviously, Bajaj parent is of very high quality. There is absolutely no doubt about it, and even the management quality is very high. The only thing that probably we are facing is mainly because of the repo rate cut. There can be some bit of pressure on the margin side, and when loan growth is going to moderate from here on, and when there is a margin pressure, that puts downward pressure on the ROE. And as you rightly highlighted, valuation is not cheap. It's trading at more than 3 and 4 times. That makes stock re-rating quite difficult.
Got that. We'll leave it there. Thank you very much for joining us. Really appreciate your time here on CNBC TV18. Well, I think we'll just get to the 9:10 call.